Have things changed this year? Do you think that there's a different risk-reward setup? How are you playing it?
Yeah, I don't think things have changed too much. I mean, obviously the stocks are down from where they peaked, but you have to remember last year it was really about inflation and the Fed. And so for the first 6 months, the market went down despite earnings forecasts going up. Then you sort of got to mid-year and earnings forecasts then finally started to come down. And I think what you're going to deal with in 2023 is the aftermath of all of those rate hikes you saw in 2022 starting to play through to earnings. And you've already kind of seen it with some of the bigger tech companies like Microsoft that have reported and guided. Now, obviously, the stocks have gone up, and you can call it the January effect or, whatever you want. But it's typical that the market tends to drive up the stocks that were oversold in the prior year in January, at least to start the year. And, that's what you've seen, right? Communication services, information technology, consumer discretionary. Those are the three best sectors this year, up, 8 to 13%. And the best sectors from last year, healthcare, utilities, staples, they're all down for the year. So I don't view this anything more than another bear market rally like we saw last year. We saw 7 of them for 9% each on the S&P 500, and you still finished the year down 19%.
That is true, which would imply, I guess, you'd be certainly not chasing things like the big caps of the NASDAQ. Although, if you look at it, Alphabet or Amazon, the earnings forecast for this year are down a lot since the middle of last year for those companies, right? They're down 15, 20, 25%. So you think that there's still more shoes to drop on that front?
Absolutely. I expect every single big cap tech company to report and to have the estimates go down for the March quarter. And in some cases, they could go down substantially. Now, obviously, you can look at this and say, well, Intel had one of the worst guidances ever, and the stock is up still 6% for the month. Microsoft's guidance on Azure was horrific. It was still up 1% for the month. But I think you don't want to confuse stock prices with fundamentals. And right now, you're starting to see big cap tech starting to take numbers down in a very large way. And the problem is valuations don't really discount that, because you've still got a trailing PE of the S&P of 18 times whenever CPI has been above 3% over the last 70 years. That multiple has been 15 times. So you're not getting paid to take the risk, whereas you can buy a 3-month T-bill, which was one of our top picks coming into the year, and get a return of 4.6%. That's pretty darn good. So I think you need to balance risk versus reward versus just looking at, well, these are down a ton, and so I can buy them. Well, everything's up in January, so it doesn't really matter.
Well, we did mention, and you mentioned last week, that you did think Intel was perhaps getting interesting after just being taken apart on that bad earnings guide and everything else. What do you see there? Is it strictly just about, valuation and low expectations?
Well, those are certainly helpful. I mean, Intel's trading at 1.2 times book value, which is pretty low. I mean, compared to a commodity DRAM manufacturer like Micron at 1.4 times, and you get an idea of how compelling the valuation is. So there you're getting paid to take the risk, but you never want to buy something just based on valuation. It's incredibly stupid. So what I'm looking at is the fact that Intel's been losing share since 2018. And in the back half of 2022, they actually started to gain a little bit of share in desktop and mobile. And the first thing that Pat Gelsinger did when he came in as the new CEO about 2 years ago is go, look, we really screwed up by not moving to EUV, which is, a very efficient way but incredibly expensive way to make chips, and we're all in now. And so that technology gap that happened with regards to TSMC, that's going to start to narrow, and I think you're going to start to see that pay dividends going forward. The final piece of it is PC demand, and we've been saying this for 12 months. We looked at and said that's just a pandemic beneficiary, just like smartphones, just like e-commerce, just like Zoom. That's going to continue to collapse. That was down 30% year over year for the industry in the fourth quarter. Intel's forecasting their own revenues down 40% in March. I think that's actually the bottom. And don't forget, Intel has a huge presence in China. China's been locked down for 3 years. Once that starts to open up, that should help them a little bit as the cloud vendors in China start to order again and the regulatory pressures come off. So for us, Intel's a lot like our Facebook call, if you remember, after they gave that horrific guidance, after their September quarter. you were sort of getting paid to take the risk. And right now with Intel, if their customers are giving them more share after losing share since 2018, it tells you something is different.
Right. And of course, Meta, just this month obviously has had some upside momentum. You got some rebuild of that valuation.